Alright friends, so the next concept that we have to study is Provident Fund, which is comparatively a larger component, alright, of salary. Provident Fund, that is the next component of salary. Now before starting Provident Fund, we should know what exactly is Provident Fund in India. And according to the Indian prevailing law, we can split Provident Funds into four. First of all, what is Provident Fund basically? What do you mean by Provident Fund? Say for example, after retirement, the employee requires some amount to live. Yes or no? So at the time of retirement, for his social security and other safety, what the employer does or what our law insists is, he should have a habit of savings. To make him save his money, what he need to do is, during the period of service, both the employee and the employer have to deposit to save money for employee's retirement life or post-retirement life. So during every month's salary, both the employer as well as the employee will contribute to what? This Provident Fund schemes. Say for example, I'll show you a simple example or a simple graph how exactly it works. Then only you will be able to conceptually understand the taxability of Provident Funds. Say for example, Mr. JK is an employee. Mr. JK is an employee of A Limited. So A Limited is the employer. A Limited is the employer. Mr. JK is getting a monthly salary of 10,000 rupees every month. 10,000 rupees every month is my monthly salary. From this 10,000, say JK is depositing 1,000 rupees to Provident Fund. This 1,000 rupees will be deducted by A Limited. That's how it works. JK does not have to go and deposit to this Provident Funds. Employer, while paying the monthly salary, will cut employee's portion from his monthly salary. So JK's portion of 1,000 will be deducted by the employer from his monthly salary, and JK only will get 9,000 rupees as what? Salary contribution per month, or that is the per month salary, net salary received by JK. And this A Limited have 1,000 rupees with them, which is deducted from the monthly salary of JK. Yes or no? And A Limited will contribute another 1,000 rupees from his own pocket. A Limited will contribute another 1,000 rupees from his own pocket, and he will deposit this 2,000 rupees to the Provident Fund. Provident Fund account. He will deposit this 2,000 rupees to the Provident Fund account. At the time of retirement, there will be employer contribution to the Provident Fund, employee contribution to the Provident Fund, interest on employer as well as employee contribution. Are you all with me? At the time of retirement of employee, the Provident Fund, there will be an accumulated amount in the Provident Fund. And the accumulated amount composition is employer contributions will be there, employee contribution will be there, interest on employer contribution will be there, interest on employee contribution will be there. Are you all with me? So this is how the Provident Fund in India works. Now, according to the concept of income tax, there are four types of Provident Funds. According to income tax law, we can split the Provident Fund into four. Which all are the four types of Provident Fund we have? Number one, they say recognized Provident Fund. What do you mean by recognized Provident Fund? Recognized Provident Fund simply means a Provident Fund which is recognized by Income Tax Department. Say for example, company MNCs like Tata and all, they maintain their own recognized Provident Funds. Their own recognized Provident Funds. What do you mean by their own Provident Fund? They'll start a Provident Fund by their own by appointing some trustees, and they will get a registration from the Income Tax Department, and the Income Tax Department, if they recognize it as a properly maintained Provident Fund, then it can be technically known as what? Recognized Provident Fund. Are you all with me? So what is the definition for recognized Provident Fund? Simply means a Provident Fund which is recognized by the Income Tax Department is said to be a recognized Provident Fund. Second one, unrecognized Provident Fund. What do you mean by that? I am maintaining a Provident Fund, but I haven't get an approval from the Income Tax Department, or I haven't approved, or I haven't given an application for registration of my Provident Fund. Unrecognized. Income Tax Department does not recognize it as a Provident Fund. We can call it as what? URPF, that is Unrecognized Provident Fund. Next is Statutory Provident Fund, alias SPF. What is Statutory Provident Fund? Statutory Provident Fund simply means a Provident Fund which is maintained by Provident Funds Act 1925. Provident Fund which is maintained by Provident Funds Act 1925 is said to be what? Statutory Provident Fund. If you are maintaining a Provident Fund according to the Provident Fund Act 1925, then that Provident Fund is known as what? Statutory Provident Fund. And there is fourth one that is said to be Public Provident Fund. It is said to be what? PPF. What is Public Provident Fund? Say for example, I am a self-employed person. I want to save amount. Say after 60 years, I'm planning to stop all my activities. So after 60 years, I need some lump sum amount to live my rest of the life. So in order to boost the savings, in order to develop a culture of savings, government says I can maintain a public provident fund. With a recognized bank, say for example, nationalized bank, I can maintain PPF account. With this SBI and all, I can maintain PPF account and I can deposit small amounts to this public provident fund every year. When I deposit this small amounts to public provident fund every year, I am eligible for an 80C deduction. We will discuss it when we discuss chapter 6A deduction. 80C deduction we will call. I can deduct that deposited amount as a deduction from my total income. So at the time of retirement, I will get a lump sum amount. Then what is the purpose of this PPF? Only to promote the culture of savings. If you didn't save, then you have to depend upon the government. That will be a burden for the government to look after you. Yes or no? Whether they actually look after you or not is an altogether different story. But a people's welfare is the government's responsibility normally. So what they are saying is, after your retirement, you yourself have to find the money. For that, we are giving you an offer at the time of your service or at the time of your profession or at the time of your earnings. You deposit amount and claim deduction. Then at the time of retirement, you can enjoy the lump sum amount for your post-retirement life. If you are a self-employed person. Normally, PPF is maintained by self-employed person. It is not necessary. A salaried person also can maintain PPF account according to his own wish. So these are the 4 types of provident funds. Listen, let's repeat which all are the types of provident funds. Number 1, recognized provident fund. It means what? A provident fund which is recognized by IT department. Number 2, unrecognized provident fund which is not recognized by an IT department. Number 3, statutory provident fund, a provident fund which is maintained according to the Provident Fund Act 1925. And finally, public provident fund. That simply means what? You can maintain a provident fund by your own with a nationalized bank. That is said to be public provident fund. So these are the 4 types of provident fund we have. Now, this is not income tax. Now we are about to discuss the provisions of income tax. Only for the better conceptual understanding, I have introduced what is provident fund and how are the classifications of provident fund. Now what department says, when you deposit an amount to this provident funds, you are eligible for a deduction, exemption, benefits, etc. Are you all with me? So let's understand what is the impact of this provident fund during the period of employment. What do you mean by during the period of employment? Listen, during the period of employment, both my employer, me, will contribute to this provident fund account. Yes or no? When my employer contributes any sum to provident fund account, indirectly I am getting a benefit. What indirectly am I getting a benefit means what? Only for my benefit, employer is spending 1,000 rupees from his pocket. Hope you remember our example. Employer is spending 1,000 rupees from his own pocket for my benefit. So when employer contributes that 1,000 rupees to provident fund account, I am indirectly getting a benefit. That benefit have to be taxed as salary normally. Yes or no? But what exactly is the treatment when the employer contributes a sum? Whether I can claim deduction when I myself contributes a sum. These all are the things that we are about to discuss. So what all are the tax implications during the period of employment when you deposit any sum to SPF, RPF, URPF, PPF? What is SPF? Statutory Provident Fund. What is RPF? Recognized Provident Fund. What is URPF? Unrecognized Provident Fund. What is PPF? Public Provident Fund. So each fund's contribution, each fund's impact, that's what we are about to discuss in a table-wise manner. First, I want all of you to listen on this theory very well. Thereafter, I'll give you time to copy this table. First, you listen very carefully. Number 1, we will discuss about employer's contribution to SPF. Let's complete SPF first. Then we will move on to RPF. Thereafter, we will move on to URPF and finally, we will move on to PPF. Listen, simple topic. Employer's contribution to SPF is never taxable in the hands of employees. Employer's contribution to statutory provident fund is never taxable in the hands of employees. It has been fully excluded from the impact of taxability. Are you all with me? So, employer's contribution to SPF not taxable. Employees' contribution to SPF allowable as a deduction. Employees' contribution to SPF, whether it is taxable, employees' contribution to SPF, whether it is taxable. See, listen. What is my monthly salary according to this example? What is my monthly salary according to this particular example? 10,000 rupees. Yes or no? But what I'm getting in my hands is only 9,000. But when I show my salary, 10,000 should be my salary. 10,000 should be my salary. And I can claim that 1,000 as a deduction from 80C, not as an expense from the head salary. Rather, the contribution, employee contribution, have to be claimed as a deduction under 80C. We will discuss it later when we discuss chapter 6A deduction. So the point is very simple. When employee contributes something to SPF, what is SPF? Statutory Provident Fund. Then what will happen? That equivalent amount of contribution from my salary is allowable as a deduction under 80C. Is that clear? Now, moving on. Now there is an interest component also. What do you mean by interest component? What do you mean by interest component? Every year on both employer contribution as well as employee contribution, there will be interest accrual. Yes or no? That is also my income. Not my immediate income, but my future income. What do you mean by immediate income? Every year I cannot withdraw that interest income, but every year there is an income accrual on my PF account. Yes or no? In future, at the time of retirement, I can simply withdraw all the money. So what they are saying is, interest is also not taxable. So pretty simple point in relation to SPF. Listen, employer contribution not taxable. Employee contribution allowed as a deduction. Finally, interest on both employer as well as employee contribution fully not taxable. So this is the impact of SPF at the time of period of employment. Now at the time of retirement, when you withdraw the amount, there is separate impact that we will discuss later. Alright, the second phase that we have to discuss is at the time of retirement, when you withdraw the amount, what is the income tax impact? That we will discuss later. First, let me complete the period of employment impact of IT. Now, moving on to the second point, that is to RPF, if you are contributing an amount, what exactly is the implication? When you are depositing or contributing an amount to RPF, what is RPF? Recognized Provident Fund. What exactly is the income tax implication? That's what I am about to discuss. Listen to the employer's contribution. So I've told you earlier, when my employer is contributing something to RPF, I am getting an indirect benefit. Yes or no? What is my indirect benefit? What is my indirect benefit? The employer is spending some money for my benefit. Alright. So what they say is, when my employer spends some money, it is allowable as an exemption, but full amount blindly is not exempted. What they say is exempted up to 12% of salary. And salary here means standard salary. What is standard salary? Basic plus DA forms part of retirement benefit plus commission if it is expressed as a fixed percentage of your total turnover. So listen friends, when my employer contributes something from his own pocket to the recognized Provident Fund, in my hands, that is not taxable, that is exempted, but there is a ceiling limit for that exemption. How much is the ceiling limit? They say up to 12% of standard salary is the maximum exemption. If there is excess contribution, that excess will be taxable as salary in the year of contribution itself. Are you with me? Normally nobody will contribute excess more than 12% because it's a hardship for the employee. Why hardship? I'm not getting the money in my hand. It has been deposited to the PF account, but I have to pay taxes from the other salary, the other portion of salary which I'm getting in my hand. I have to pay taxes for this contribution also from the other amount. Yes or no? I'm getting a monthly salary, a net amount of 9,000. From that 9,000, I need to pay taxes for the excess contribution also. So it will become a hardship for the employee. So practically nobody will contribute more than 12%. But in exam, they will contribute. In exam, there is no practicality. They will contribute more than 12%. So what to do in such cases? Up to 12% exemption. Over and above 12, that excess will be treated as what? Taxable salary. Moving on. What happens when the employee contributes employee contributes for the benefit of himself? Again, from his taxable salary only he contributes. As I've told you, 10,000 will be a salary. Out of that only he will contribute. That contribution he can claim as a deduction under 80C. Just like SPF, he can claim a deduction under 80C. But under 80C, there is a ceiling limit. Maximum 1,50,000 is the yearly contribution that allowable as a deduction. That we will discuss when we discuss chapter 6A. For the time being, only understand when the employee, he himself contributes from his pocket to RPF, he can claim a deduction under 80C. Now, finally, the interest component. It is also exempted, but not fully exempted. They say exempted at 9.5% per annum. Any excess interest will be taxable as salary. That simply means interest. If the percentage of interest every year is more than 9.5, excess will be your taxable salary. How much interest is exempted? 9.5%. Up to 9.5% interest is fully exempted, not taxable. If your contribution is more than 9.5%, then the excess shall be taxable at what? Salary. So, to RPF is also very simple. What all are the components? Number one, employer contribution, exempted, but only up to 12% of standard salary. Employee contribution, allowable as a deduction, 80C. Interest component, exempted, but the maximum exemption shall be 9.5% interest. That's it. I hope it is clear. That is the impact of what? RPF. Now let's understand the impact of URPF. What is URPF? Unrecognized Provident Fund. Are you all listening? Let's understand the impact of what? URPF. Listen, it's very interesting. What is URPF? What is basically URPF? Income tax department is not recognizing that particular fund. Yes or no? Income tax department is not recognizing that particular fund, some fund. When your employer is contributing some amount to some fund, no impact. Why no impact? Because income tax department doesn't know whether that fund is for your benefit or not. You are being the employee. Say I am being the employer and you are the employee. I am contributing something to some fund. Income tax department doesn't know whether that contribution is for your benefit or not, because they don't recognize such a fund. Yes or no? So when the employer contributes anything for the benefit of employee to URPF, there is no tax impact in the hands of employee. Then you will think that this is more beneficial. Why? Because RPF over and above 12% shall be taxable. Here, how much you contribute, not taxable. Yes or no? But there will be implication at the time of withdrawal. At the time of withdrawal, when you really get the money, when the employee really get the money, there will be cumulative taxation. All the amount will be taxable. Are you with me? So it's the deferment of taxes. When you contribute something to what? URPF, the taxation is getting deferred. What is taxation is getting deferred? The taxability will be at the time of retirement, not at the time of contribution. Are you all listening? Moving on. When employee himself is contributing from his own pocket to URPF, no deduction. Why no deduction? Income tax department does not know to what fund you are contributing. They only know you are contributing to something. Why should we give deduction for your some kind of contribution? We should give. No, we shouldn't. So they say we will not give any deduction for your URPF contribution. Now interest is also not taxable. It is also tax deferment. At the time of withdrawal, we know how to tax you for. So at the time of deposit, go away. No problem. All right. We are deferring the taxability. Now, finally, moving on to the last point, that is said to be what? PPF. What is PPF? Public Provident Fund. Employer contribution, they say not applicable. Why not applicable? Why not applicable? Employer contribution. Self-employed persons only will take what? PPF. Even if employed persons take PPF, it have no nexus with your employer. Your employer is not going to contribute anything to your PPF. PPF is your personal account. On your own wish, you maintain that. Employer has no responsibility to contribute any amount to PPF. So there is no employer contribution as it is. Hence, that's why it is written not applicable. When you yourself are contributing to PPF, you can claim that contribution as a deduction under 80C. Again, interest on PPF is also not taxable. Any interest accrued on PPF is fully exempted. So this is the impact of what? PF account at the time of employment to SPF, RPF, URPF, PPF. We have discussed everything. I hope it is super clear for you. Now we will move on to the second one, that is called as at the time of retirement. All right. Now during the period of service, when we deposit to that particular fund, we understood what exactly is the income tax implication. Now let's understand when we withdraw at the time of retirement, death, etc., what will happen? The implication is what we are about to discuss. Be very attentive. This is a little bit complicated. All right. Now listen. So the first point that we need to say is recognized provident fund, public provident fund, statutory provident fund. The payment received by an assessee from the following funds at the time of retirement or otherwise would be fully exempted from tax under section 1011 and 1012. Now listen, this wording is not that correct. Even though departments say full exemption, we will not get full exemption. There are certain conditions, limitations, etc. So the point is, I want to rephrase the sentence. What I will say is, when an employee withdraw from recognized provident fund or a public provident fund or a statutory provident fund, he is eligible to get an exemption under section 10 subsection 11 and 10 subsection 12. Statutory provident fund and public provident fund withdrawals are eligible to claim exemption under 10 subsection 11. For the other one, recognized provident fund withdrawal is exempted under section 10 subsection 12. Are you all with me? So let's understand how exactly is this particular exemption. At the time of retirement, what we can do is we can split exemptions into two. At the time of retirement, we can write any withdrawal from RPF bar, SPF bar, PPF is exempted, and the exemption has been splitted into two. The first set I will write exemption under section 10 subsection 11. Exemption under section 10 subsection 11. What they are saying is, when you withdraw an amount from public provident fund, PPF, I will write PPF bar SPF, you can claim an exemption at the time of withdrawal when you are withdrawing an amount from PPF or SPF. The section which provides exemption is 10 subsection 11. Are you all listening? The section which provides exemption is 10 subsection 11. As I've told you earlier, this 10 subsection 11 is not a full exemption. There are certain limitations. So let's understand what exactly is a limitation. So please listen. Under that, let's write a note. For the limitation. So what they say is, when you withdraw an amount from this particular PPF or SPF, we will consider SPF right now. When you withdraw an amount from SPF, what are the components you have in SPF? When you withdraw an amount from SPF, which all are the components in SPF? Employer contribution, employee contribution, interest on employer contribution and employee contribution. Yes or no? So the limitation is applicable for interest portion. What they are saying is, listen, income by way of interest accrued from SPF shall not be exempted shall not be exempted, shall not be exempted, shall not be exempted if aggregate contribution if aggregate contribution made by employee exceeding rupees 2,50,000, exceeding rupees 2,50,000. So friends, listen, it's a bit technical. Listen. So what they are saying is, when you retire and you withdraw an amount from SPF, there will be employer contribution, employee contribution, interest on employer contribution, interest on employee contribution. These are the four components of your lump sum amount in SPF at the time of your retirement. Are you all with me? Out of these four components, three components are fully exempted. Which all are the three components? Three components are fully exempted. That is employer contribution, employee contribution, interest on employer contribution. These three components are fully exempted. There is absolutely no problem. These are fully exempted under section 10 subsection 11. But there is a restriction for the fourth component, which is the fourth component which is missing in this list. Which is that? Interest on employee contribution. Interest on employee contribution is also exempted, but there is a limitation. What is that limitation? They say income by way of interest accrued from SPF shall not be exempted if aggregate contribution made by employee exceeding 2,50,000 in a year. So we can write in a year as well. We can write in a year at the end as well. In a year. What do you mean by that? Say during the period of your employment, if in any year, if you have contributed an amount of more than 2,50,000 to SPF, then interest on that excess contribution over and above 2,50,000 alone will be taxable, and that too taxability is at the time of withdrawal. Are you with me? Say for example, every year employee contributes 3 lakh. Every year employee contributes 3 lakh. Every year employee contributes 3 lakh to this say what? SPF. Are you all with me? Are you all with me? Employee contributes 3 lakh. Then on this 3 lakh he will get interest. On this 3 lakh he will get what? Interest. And this interest can be enjoyed by the person only at the time of withdrawal. This interest can be enjoyed by the person only at the time of withdrawal. At the time of withdrawal, interest on 50,000 will be fully taxable. What is the rate of interest? That we don't know. Depends upon the fund. Rate of interest we don't know. But the interest on that excess 50,000 alone will be fully taxable. Up to 2,50,000, interest is not at all taxable. Over and above 2,50,000, if you are accruing an interest income, that entire interest income will be taxable at the time of withdrawal. That's what the department says. Now, under that, let's write one more point. Let's write one more point under that. So, that is note number 2. Note number 2. In case of PPF withdrawal, in case of PPF withdrawal, in the case of PPF withdrawal, instead of 2,50,000, limit shall be 5 lakh. Limit shall be 5 lakh. What do you mean by instead of 2,50,000, limit shall be 5 lakh? That simply means, see, from SPF, when you withdraw an amount, the withdrawal over and above 2,50,000 was only taxable. When it is the case of PPF, then interest on excess contribution over and above 5 lakh only will be taxable. Say for example, every year a person contributes 6 lakhs. Every year a person contributes 6 lakhs to PPF. Interest on 1 lakh rupees will be taxable at the time of withdrawal. Interest on 1 lakh rupees shall be taxable at the time of withdrawal, because instead of 2 lakh 50, interest accrued on excess amount of 5 lakh will be taxable in the case of PPF. In the case of SPF, it is 2 lakh 50, and PPF it is 5 lakh. This is what they say. Moving on to the next point. Under that, there is one more note. Note number 3. Note number 3. So the point is, any interest as above, if accrued on or before, any interest as above, if accrued on or before 31st March 2021, on or before 31st March 2021, shall be fully exempted. Shall be fully exempted. What do you mean by this? This means, simple point, these two notes which we have written, one on SPF and one on PPF, this is effective from 1st April 2021 only. 1st April 2021 only. That simply means, if there is an interest accrual over and above 2,50,000, then that interest accrued only on or after 1st April 2021 will be taxable at the time of retirement. In the case of PPF, interest accrued to a contribution which exceeds 5 lakh shall be taxable only on the accruals which happened on or after 1st April 2021, because this provision is there in the income tax with effect from 1st April 2021 onwards only. That's why I said all the interest accrued before 31st March 2021 shall be fully exempted. There is no income tax implication from PPF and SPF withdrawal for employee contribution or on contribution. This provision is there only from 1st April 2021. All the interest accrued before 31st March 2021 shall be fully exempted. So this is what the Act says as a part of your PPF and SPF contribution. I hope it is clear. Moving on to the next point, that is withdrawal from RPF. What is RPF? Recognized Provident Fund. Exemption shall be enjoyed under section 10 subsection 12. You can claim exemption. Exemption can be enjoyed under section 10 subsection 12. So let's understand what exactly is the exemption under section 10 subsection 12. And in this 10 subsection 12 also, what they say is, this exemption under section 10 subsection 12, there are certain conditions. There are certain conditions to claim this exemption under 10 subsection 12. So let's understand which all are the conditions. Listen, let's understand the conditions, how to claim exemption and all. So the first thing they say, in the following cases, assessee can enjoy exemption. In the following cases, assessee can enjoy what? Exemption. So let's understand which all are the scenarios where assessee can claim exemption. So scenario number one, if employee retires after 5 years of continuous service. Simply means what? Say you are retiring. Only at the time of retirement you will get this Provident Fund. Yes or no? You are retiring after 5 years of continuous service. Then what is your advantage? If you are retiring after 5 years of continuous service, then you are eligible for an exemption under 10 subsection 12. You can enjoy the entire withdrawal as an exemption. If you have 5 years continuous service, don't even think about any taxability from withdrawal from RPF. What is RPF? Recognized Provident Fund. Number two, if employee does not have 5 years continuous service, but subpoint number one, employee does not have 5 years of continuous service, but what you have done is, he after retirement, employee joined another company or another, not company, another organization we will write. another organization and balance in RPF, transferred to new employee. What do you mean by that? So this looks like a very long point, but very simple point. Listen, say, first point that you should know, if I have 5 years of continuous service, then I don't even think about what taxation. If I have 5 years of continuous service, then what will happen? If I have 5 years of continuous service, then all the withdrawals from RPF is fully exempted. I can enjoy exemption under 10 subsection 12. This is the first thing to note. Second point is, if I don't have 5 years of continuous service, then normally it should be taxable. If I don't have 5 years of continuous service, normally it should be taxable. But they say, if I don't have 5 years of continuous service, that means I've retired before 5 years. I've joined the company and retired or got out before 5 years. So, for example, I'll give you an example. Say I've joined Tata in 2018-19. In year 1, I will call it as year 1. In year 1, I joined Tata. In year 3, I resigned from Tata. So, year 3, I resigned. Whether I have 5 years of continuous service? The answer is no. I don't have 5 years of continuous service because on 3rd year, I got retired or I got resigned. Yes or no? But what I've did is, on 3rd year, I've joined another company called Reliance, or I'll say Jio. I've joined in Jio. And I've transferred all the RPF to this new employee. Rather than realizing the money, I've transferred all the money to the new employer. If it is the case, then there is no taxability. There is a withdrawal from Tata's account, but that amount have been deposited in Jio's account. Are you all with me? If it is the case, then there is no implication of income tax, because earlier Tata was the fund manager. Right now, he withdrawn all the fund from Tata and deposited the entire fund in Jio. It's a direct transfer to your new employee. So in such case, you haven't actually realized that money. You have withdrawn from the old account to the new employer. So you haven't withdrawn the amount and hence there is no taxability. Are you all with me? Now, and thereafter when you resign from Jio or retire from Jio, you can count combined service as 5 years. That means 3 years I worked with Tata, then another 3 years I worked with Jio, and after this 3 years I am retiring. A total period of service can be taken as 6 years. I can count the past employer experience also while counting that 5 years. Are you all with me? Now listen, moving on to the second scenario, that is second subpoint. I hope you are writing with me. At the time of retirement, entire RPF balance transferred to pension fund under section 80 CCD. So if the employer say retiring on the 3rd year, the employee is actually retiring from the employer. Are you all listening? 3rd year employee has retired, and what he have done, instead of realizing the money, he transferred the balance. The balance is transferred to his pension fund under 80 CCD. Rather than realizing the money, he withdrawn the amount but deposited the entire amount in 80 CCD pension fund, National Pension Fund, 80 CCD. We will discuss 80 CCD when we discuss chapter 6A. For the time being, simply understand it as a pension fund. Withdrawn from RPF, deposited in pension fund. Again, no taxability. No taxability has been excluded from the ambit of taxation. You can enjoy the exemption under 10 subsection 12. Scenario 3. If retirement is due to health of employee, ill health of the employee, right? Ill health of the employee, or discontinuation discontinuation of business of employer, discontinuation of business of employer, or any other reason beyond control of employee, or any other reason beyond the control of employee. Alright, what do you mean by this? Listen friends, if retirement is, say, on third year, my health got bad, I got an accident, or my health got bad, I cannot work anymore, so I retired and withdrawn the amount. There is no taxability. Are you all with me? So on third or second or first year, if I am withdrawing the amount due to my ill health, there is no taxability. Or due to discontinuation of business of employer. What do you mean by discontinuation of business of employer? The employer's business got discontinued. He discontinued his business. Business was at loss. So on fourth year, he discontinued the business. I withdrawn my entire provident fund. There is no problem. Or any other reason beyond the control of employee. What do you mean by any other reason beyond the control of employee? Say for example, I lost my job not due to my activity, not due to my act. I lost my job due to some other factors which is beyond my control. Say for example, the government banned my company's product. Government banned my company's product and government recommended a compulsory liquidation. Then what will happen? I will lose my job. In such scenarios are not in my control. So in such scenarios, if I am withdrawing the amount before 5 years, I can claim what? Exemption under 10 subsection 12. Are you all here? So these are the scenarios where I can claim exemption under 10 subsection 12. Number one is a common point. Which was the common point? If I have 5 years of continuous service, I don't need to think about any other points, full exemption I can claim. If I don't have 5 years continuous service, then only I need to check the sub points. Which all are the sub points, friends? Which all are the sub points? So the first sub point what they say is, if I don't have 5 years of continuous service, what I need to check is whether after retirement I have transferred my entire RPF balance to new employee. New employer, not employee, new employer. If yes, no problem, no taxability. Whether after retirement I have transferred that entire balance to a pension fund. If yes, no taxability. Whether the retirement is due to my ill health, or due to discontinuation of business of my employer, or due to any other reason which is beyond my control. In such scenarios also, there is no taxability. Now, what if I've resigned by myself and I've enjoyed the entire amount by withdrawing the amount? It will be taxable. If I've resigned voluntarily without any other reason and I have transferred that, I haven't transferred that amount to any pension fund or to any other new employer, then what will happen? It will be taxable. Yes or no? Then how is the taxability? We can write it under that write a note. Under that write a note. If amount withdrawn from RPF is taxable, then taxability shall be same as the case of URPF withdrawal. Taxability shall be same as the case of URPF withdrawal. Arey, what do you mean by URPF withdrawal? If RPF withdrawal is taxable, then the taxability will be similar to taxation of URPF withdrawal. What is URPF withdrawal taxation? That we are about to study. Are you all listening? URPF withdrawal we haven't studied yet. We are about to study URPF withdrawal. That is the next topic. Alright. So what they are saying is, if in any circumstance your RPF withdrawal is taxable, then the taxability will be similar to what? URPF withdrawal. That's what they say. I hope it is clear. Now friends, under that there is one more note. There is one more note under that. I hope you are writing all these notes. The last note under that, it says if employee contribution. Employee contribution to a recognized provident fund exceeds rupees 2,50,000, then interest accrued thereon. Interest accrued thereon on excess contribution. On excess contribution. Excess contribution shall be taxable. Shall be taxable. Shall be taxable. The same point which we have written in SPF. Hope you remember. So this point is actually similar to that SPF taxability. If the employee from his own pocket is contributing over and above 2,50,000, interest accrued on the excess contribution shall be fully taxable. He cannot enjoy exemption under 10 subsection 12 on excess contributions interest. Excess means over and above 2,50,000. Interest on excess contribution is not eligible as an exemption under 10 subsection 12 at the time of withdrawal from RPF also. Now, there is one more note. What will be the note? Any interest accrued on or before 31st March 2021 shall be fully exempted under section 10 subsection 12. Why? Because this is effective from 1st April 2021 onwards. So, we can write second note. Any interest accrued. Any interest accrued on excess contribution. Excess contribution up to 31st March 23, sorry, not 23, 21, shall be fully exempted. Shall be fully exempted in accordance with section 10 subsection 12. What do you mean by in accordance with section 10 subsection 12? For that interest also you should have that 5 years experience or the other conditions which we have discussed under 10 subsection 12. Exemption will be as per section 10 subsection 12 always. So, the point is very simple. From 1st April 2021 onwards, if the employee is contributing over and above 2,50,000 rupees to RPF, interest accrued on that particular excess contribution shall never be exempted. You have to pay taxes whether you have 5 years continuous service or not. That's what they say at a part of this. I hope this is clear. Now, to the main other part, withdrawal from URPF. That's what we are about to discuss. So let's understand withdrawal from URPF, friends. Listen. So withdrawal from URPF. Now, friends, you have to be extremely attentive here. All right. So what was URPF? What was URPF? Unrecognized Provident Fund. When you are withdrawing some amount from URPF, how to compute taxes on that particular withdrawal? Let's understand. So, what they are saying is point number 1, in URPF account, there will be 4 components. Which are the 4 components? Employer contribution, employee contribution, interest on employer, interest on employee. Yes or no? Now, when you are withdrawing, accumulated employer contribution shall be fully taxable under the head salaries. When you are withdrawing an amount from unrecognized provident fund, all the accumulated employer contribution shall be taxable under the head salaries. Because at the time of deposit, we have deferred. Hope you remember. At the time of deposit to URPF, employer contribution, it was not at all taxable. The complete taxation, I've told you it earlier, the complete taxation have been deferred and that will happen at the time of withdrawal. That's what they say. All the employer contribution, out of that lump sum amount you withdraw, out of that how much is the employer contribution, that entire contribution will be taxable under the head salaries. Number 2, accumulated employees contribution not taxable. Why? Accumulated employee contribution, they say not taxable. Reason, Array, already that is taxable as your salary. Out of that amount only you contributed to the unrecognized provident fund. It is just like getting back the money. Are you all with me? See, for example, when you are depositing money in bank and withdrawing the amount, it is not your income. Only the interest component is your income. It is just like you deposit and withdraw. At the time of receipt of salary, your entire income is taxable. Out of that taxable income only you have deposited to URPF. Now at the time of withdrawal, you don't have to show it as your income again. So it is not at all taxable. Then, third one, accumulated interest on employer's contribution again shall be taxable under the head salaries. Employer's contributions interest alone again will be taxable under the head salaries. And how about employees' contribution interest? Under IFOS. Because it is an unrecognized provident fund. It is just like a bank deposit or something. Alright. So, when on employees' contribution, if there is an interest accrual, that interest shall be fully taxable under the head IFOS. So, very simple. URPF, listen. All the employer contribution, salary. All the employee contribution, not taxable. Interest on employer contribution, salary. Interest on employee contribution, IFOS. Done. Since we cannot enjoy any exemption, there is no condition, fully taxable. When there is an exemption, there is a problem. They will come up with some conditions here and there. Alright, there is no exemption. It is very easy, fully taxable. Only the head. That's what you have to remember. Employer contribution and his interest, salary. Employee contribution not taxable. His interest, IFOS. Done.